Hello, my name is Sean. I'm the publisher and translator of The Missing Billionaires. I'm here with In-Yeop Kim from Korea Economic Daily Global. This interview is brought to you by Business 101 Publishing and the Korea Economics Daily Global. Today, we are excited to welcome two special guests, Mr. Victor Hagani, the managing partner of Elm Wealth, and Mr. James White, the CEO of Elm Wealth. These two gentlemen are the authors of The Missing Billionaires. The Missing Billionaire is a field with the financial concepts that investors often overlook. Especially the book emphasizes the importance of understanding on the investor personal level of a risk aversion and determining the optimal investment size based on that risk aversion before making investment decisions. Mr. Lagani and Mr. White, thanks for joining here today. Can you introduce yourself to the Korean audience? What made you write The Missing Billionaires?
So my name is Victor Hagani, and I've had a career in finance since 1984 when I started at Solomon Brothers in research and then went into trading and then was one of the founding partners of LTCM. And then I started Elm Wealth in 2011, which was really an about face for me, a 180-degree turn away from proprietary trading and hedge funds and trying to beat the market, because I wanted to, for my own family, to invest in low-cost index funds, but in a sensible way. And so this was really, a very big change from what I had been doing before. And when James and I became friends and business partners, we kept talking about how important risk is as part of the big financial decisions that we have to make. If you get your sizing decision wrong about how much risk to take, that can be a bigger problem than even choosing the wrong investments. The selection question of what to buy is important, but even more important is getting the risk question reasonably correct. And so we decided to write a book which was aimed at our younger selves, you could say, that we wish that we wanted to write a book that would have helped us to have had more successful financial careers and decision-making, and that's why we wrote The Missing Billionaires.
Yeah, it's a pleasure to meet you. I'm In-Yeop Kim from Korean Economic Daily. I want to ask about the story of the long-term capital management that you mentioned. And interestingly, the book was translated by our company, Korean Economic Daily. I want to hear what was the key lesson you learned from the long-term capital management and how that experience impacted you personally and professionally.
I had better also be the one to take this one. So I think that the key lesson from LTCM, as I was really touching on in my previous answer to your first question, is that how important it was to get the sizing question right. And in the case of LTCM, I feel that I personally got the sizing question wrong, that we had lots of good investments in our portfolio. And in fact, over time, almost all of the investments in the LTCM portfolio performed very well. But we just had too much risk in the portfolio. And even worse than that, in terms of the kind of mistake that it was, is that I had personally too much invested in LTCM myself, between investing my savings in the fund and my human capital being so connected to the fund, and then also owning part of the management company of the fund, that all of those things together was such a huge exposure that when LTCM lost money, it was too big of a loss for me. Luckily I didn't have everything invested in there, but I had too much, and I wasn't really thinking about sizing in a coherent, intelligent, sensible, logical way.
You emphasize that how much to invest is more important than what to invest in. So what made you think in that way?
Imagine that you have an investment and it's a good investment, but it has quite a lot of risk. And you size it incorrectly. Just intuitively, you can see how normal ups and downs can force you to sell it, can drive you bankrupt, can cause lots of really unpleasant, unpalatable outcomes that end your ability to invest in the future, even if it's a very good investment, but a volatile one. In contrast, if you have a bad investment, but sized correctly, you should be able to live to invest another day. And that feature is intuitively very important. And when you go through the math supports that when you get into the theory of optimal decision-making under uncertainty and thinking in terms of risk-adjusted returns rather than absolute returns, and once you start doing that, what you see is that there's no real-world investment for which there isn't a size which makes it a bad investment. Any investment with non-zero volatility can be oversized. In contrast, the only investments for which you want literally none of that investment, assuming you can't go short, are investments with negative expected return. So any investment, no matter how marginally positive it is, if it has a positive expected return, will have some size, maybe very small, in which you want that investment. But on the flip side, no matter how good the investment is, if it has some volatility, there's a size which is too much.
I think one of the key concepts that explain that the concept of risk aversion must be the flipping coin experience that you wrote at the book. Can you explain it briefly? I mean, I know the whole story about the flipping coin, but many of the viewers must have not heard about it. So,
sure. So we have wondered whether it was just us that didn't really understand how to size investment risk very well when we were younger. Eventually we figured it out, but we were thinking, well, maybe everybody intuitively has a really good grasp of that. But it was just us or a small set of people like us that weren't very good at it. So we decided to run an experiment where we allowed people to make bets on a coin that we told them and which we programmed to have a 60% chance of landing on heads and a 40% chance of landing on tails. And we went out to a bunch of, I think about 140 people that had some financial training. Some of them were in grad school in finance. Some of them were working in the financial industry already. And we gave each one of them $25 and we told them, you can flip this coin for half an hour. You can bet as much or as little of your bankroll as you want on it. And at the end of a half an hour, we'll pay you however much you have grown that $25 into, up to a maximum value of $250, so 10 times their money. So, for a half an hour work, that was a pretty good return for people if they could make $250 from being in this experiment for a half an hour. So we thought the money was like a reasonable amount of money to see how people did. And then we measured how they did their betting. And the results of the experiment were quite surprising to us. About 25% of the players went bust, and only about 25% of them reached close to $250. And what we show is that with a very simple betting strategy of just betting anywhere from 10% to 20% of your bankroll on heads every time, and playing quickly, that you would have like a 90% chance of getting very close to $250. So the payoffs would have been much bigger. And then we asked many of these players, how did you think about it? What did you bring to it? Did you have any training that you could use in this game? Were you taught anything in your finance programs. And what we found that almost nobody had heard of the basic concepts of how to bet on a favorable opportunity. So yeah, it really was one of the things that made us feel that writing this book made sense, because we felt that there was a need for people to think about this and to understand this. And the title of our book, The Missing Billionaires, in some ways is like a natural experiment instead of using these coins in a formal experiment. The Missing Billionaires puzzle is kind of a natural experiment in the same thing, where we're saying, wow, isn't it amazing that very, very wealthy people are not able over long periods of time to maintain their relative wealth? And it's not a controlled experiment. There's a lot of different things that could explain it, this puzzle of the missing billionaires. But we think a really big part of the explanation in many, many cases is this poor decisions around how much risk to take in investment portfolios and also in spending policies, because that's there's also a question of risk in your spending policies. So anyway.
Oh, you mean even the best financial professionals can fail, even though they have the better chance of winning? In this case of flipping coin experience, which was 60%, if they do not invest appropriate amount of their money, right?
Well, just imagine that if every time you bet 50% of your bankroll on heads every time, then so you start off with $25, and if you bet $12.50 on the first flip, okay, you have a 60% chance of winning and a 40% chance of losing. So that's good, but okay, the problem is that if let's say that you win, and now you have $37.50, and now you bet again, and you bet half of that, so now you're betting $18.75. Well, if you lose, you're going down below $25, right? It's hard to do the numbers exactly on this call like this, but you can see that if you're betting too much, even though you're winning 60% of the time, your wealth is, if you do get 60% of the time heads, you wind up losing most of your money, right? So it's like if you bet 100 times and 60 times heads comes up and 40 times tails come up, but you bet 50% of your wealth on every single flip, even though you did get 60 heads and 40 tails, you will find that your wealth is very close to zero. People don't intuitively see that, right? It's like, wow, I won 60 times, I lost 40 times. That's what's supposed to have happened. And so I bet, it wasn't like I won only 49 times and I lost 51 times. You could understand why you would lose money then. But I won 60 times and I lost 40 times, but I went bankrupt, basically went close to bankrupt because I was betting too much. And you can see that in the extreme, right? Let's say that you're betting 100% of your money on every flip, right? Well, now, even if you won 99 times, which would be almost impossible, but if you won 99 times and you lost one time, you would have zero wealth, right? That's really clear. But that is actually the highest expected return strategy that you could follow, is to bet all of your money on heads every time. And that's what, Sam Bankman-Fried from FTX, that's what he said he would kind of do if he were presented with that game. And it didn't turn out too well for him, as we know, that kind of approach to risk-taking. What he called expected value. But what we talk about in the book, it's not expected value that you want to maximize, it's expected utility.
Yeah, that concept might explain the notion that do not put the eggs in one basket, like an portfolio diversification. So what would be the ideal asset allocation ratio, you think?
Yeah, so we don't think there's one answer. to the question of what is the ideal asset allocation. In the intro to the book, one thing we talk about is that we really view this book as a book about teaching people how to fish, not telling people exactly what to eat. So the whole book is really about the idea that the ideal asset allocation is a function of your personal risk preferences, your spending dynamics, your opportunity set in terms of what you can invest in. And there is a method, which we talk about in the book, for how to turn all of those things into a single risk-adjusted return metric. And then you can find, for whatever your opportunity set and whatever your personal risk aversion is, the right mix that optimizes your personal risk-adjusted return. And one important aspect of this is that it's individual. Even if you and me and Victor all have exactly the same opportunity set in terms of what we can invest in, our optimal portfolios will look different because we have different subsistence spending levels. We have different levels of risk aversion. Perhaps we have different horizons, which may or may not matter. And what we really wanted to get across was how people can figure those things out for themselves, given their own situation, not have to rely on blanket advice for some kind of average situation, which may or may not be applicable to them.
You mean every person has their own risk preference, and you need to invest based on that risk aversion preference, right?
That's right.
So I get to curious, who are the customer of Elm Wealth, and what kind of portfolio do you offer to the customers?
In our minds, at least, the first customers of Elm are me and Victor. I wasn't literally the second customer, but Elm was originally developed to manage Victor's wealth. When we were a younger business, most of our clients were wealthy senior finance professionals. As we have grown, that's broadened considerably, where still most of our clients are relatively wealthy, sophisticated people who have been thoughtful about finance and are interested in sensible investing. But the through line tends to be that they have an interest in the kind of optimal decision making we talk about in the book, and also an interest in rules-based investing, algorithmically driven investing, rather than human-driven discretionary investing. And I should also add, we have clients all over the world. We have U.S. clients who invest with us primarily through separately managed accounts at Fidelity, Schwab, and JP Morgan. And for those clients, we offer a range of customized investment choices that are parameterized in specific ways. And then for non-US clients, unfortunately, it's generally not tax efficient for those clients to invest in our US vehicles. And so we have an offshore fund that many non-US clients can invest in.
So you offer each of the customers different portfolio, right?
Yeah, for our US clients, we do.
I guess many of Korean viewers who are watching this must be really curious about what is the portfolio of you, Mr. Victor and James. So can you give us a little bit of clue?
One feature of Elm, which I neglected to mention, is that the asset allocation isn't static. one of the big principles is that the optimal asset allocation is, amongst other things, a function of risk premia, where we define risk premia as the extra expected return you get from a risky asset relative to a low risk or a risk-free asset. And so one of the features of Elm is that we are constantly measuring the risk premia of various global equity markets and taking more or less risk as those risk premia go up and down. Now, one way we calibrate it is we ask ourselves, how much equity risk do I want when risk premia are at 4%? And formally, the answer to that is a function of your risk aversion. So the more risk averse you are, the less equities you would want in that environment. Myself and Victor, we set our baseline. We call that the baseline equity level. We set our baseline at 75%. So when risk premia are at 4% and risk levels are kind of neutral, we're going to have 75% of our wealth in equities. Then in environments where, for example, risk premia are wider, if risk premia are 8%, we'll have 100% of our wealth in equities. If risk premia are at 1% globally, we're going to have very little of our wealth in equities, and most of our wealth is going to be in tips and treasury bills and fixed income. But for me and Victor, and this doesn't mean it's right for everybody, it's right for us, given our risk aversion, we set ourselves so that we have 75% equities at a 4% risk premium.
So I have a question, just a brief question. So 75% equity, that is I believe is equivalent to personal level of the risk aversion, probably 2 and 3 or in between.
That's right.
Sorry, but it's important to say, with the assumption that equities have a 4% extra return relative to safe assets, and that equity volatility is kind of normal. So, that 75% is what you get. For instance, I think that's about what you get with a 4% excess expected return, and the belief that equities has about a 16% annual volatility. And that would be a coefficient of risk aversion of just a little bit over 2. So it depends, it really is, it's those three things that have to come together: expected return, risk, and your degree of risk aversion. And that's how we like to ask the question of people and say, well, imagine you're in this world in which equities has normal kind of volatility. It's offering an extra 4% relative to safe assets. And, how much equities do you want in that case? And now the person has kind of answered their feeling about risk aversion, and also what they think normal equity volatility is like.
I want to ask about you at the book. You mentioned why it is important to focus on the yields on the tips instead of U.S. Treasury bond, and then why should investors use the tips as a benchmark instead of U.S. Treasury bond?
The first thing that with regard to this question is that it's just easier that what really matters to us is how is the inflation adjusted wealth and spending power of our wealth, how is that changing over time, right? That, with different levels of inflation, we don't really want to focus on just how much money do we have, but we want to think about everything in terms that are adjusted for inflation and adjusted for cost of living, let's say. So first of all, it just makes everything easier when we focus when we convert the world that we see of nominal prices and nominal returns and nominal wealth. When we turn everything into, inflation adjusted, it just makes everything easier to think about, by taking that variable out. And also, it just is the case that it's much easier to think about expected returns of the stock market as being naturally easier to think about adjusted for inflation. It just is, that when you think about the expected return of the stock market, that the way that you would do it is you would think about what it is in real inflation adjusted terms, then you would make some inflation estimate and add it to that. So instead of doing that, just forget about inflation, just think about everything in a world that's adjusted for inflation. And, that gets more to the core of what's important for us as we think about the very long term. And so once we're in this world of thinking about everything in inflation adjusted terms, it becomes very natural to use TIPS, which has a yield that's in inflation adjusted terms, in real terms, as the natural kind of safe asset. And then we think about long-term TIPS as opposed to short-term TIPS, that we think that long-term TIPS kind of make more sense to think about, because what we want to do with our wealth is spend it over the rest of our lives, or we might be giving some of it away, but whatever it is, it's not all happening next year. Hopefully, for most of us, it's not all happening next year. We have many years ahead of us. And so we really want to think about not how much wealth we have today, but what our wealth can achieve for us over the long term of our lives, maybe the lives of other people, of our children, or people that we want to help. And so long-term TIPS, is kind of the best safe asset to think about, and thinking about wealth as long-term spending is better than thinking about it as the lump sum today that you see. It would be much better if we thought about our wealth as, how much equivalent spending can it generate each year for the next 30 years. That would be a more helpful way of monitoring our wealth and thinking about it than thinking about how much wealth do we have today in our bank account and brokerage account and balance sheet.
In the book, you told there's a conventional advice for the senior investors that you should reduce the allocation of stock and increase the safe assets like a U.S. Treasury bond. But you challenge such a concept. Can you tell me the reason?
The important takeaway I would have on this topic from the book is that time horizon by itself is not a big driver of your optimal asset allocation, assuming a variety of standard assumptions about the distribution of and nature of asset returns. One of Merton's conclusions, again, assuming normal distribution and other important things, is that your optimal allocation doesn't change as a function of horizon. Now, as we get older, a number of things happen. And depending on your situation, it may or may not be the case that your optimal allocation should go up, go down, or stay the same with time. And importantly, one of the things that's happening, let's say you're going to die around 85 years old. So as you get older, your time horizon is shortening. That by itself is not so important. However, there's other things happening too. One thing that's happening is that possibly your wealth is going down. Let's say you retire at 65 and you don't have any income anymore and you're spending more than your investment income. So your wealth is going to be going down. Let's say you don't have any kids. Well, it's rational to spend down your wealth over time, but you also have some subsistence wealth level, the wealth level which you would effectively feel broke, which isn't zero. If I only had $50,000 to my name, I would effectively feel broke, even though I'm not literally broke. So as my wealth approaches my subsistence consumption, my optimal asset allocation is going to go down. It's going to become less risky. And that's happening because I'm getting older and spending money, but it's not happening because my time horizon is compressing. Or it could be the other way around. It could be that as I get wealthier because of income or whatever, my wealth is going up over time. And that I'm moving as I get older, even when I'm very old, if I'm in my 80s, it could still be the case that my wealth is going up and I'm moving further away from my subsistence, in which case my optimal asset allocation could be rising over time. So in this thought experiment, I didn't have kids. But now let's say I have a family, I have children, and I want to leave them a material amount of my wealth. If, to make it an extreme example, let's say I'm going to spend 20% of my wealth on me, and I'm going to leave my family 80% of it, then my personal situation, my life expectancy, my spending is a relatively small part of what's going on in my total wealth picture. Most of it is really about my heirs. And so in that case, it especially doesn't make sense for me to be reducing my asset allocation as I get older, because my heirs, assuming they have human capital of their own and whatnot, it's probably appropriate for them to take quite a lot of risk. And so, the lesson we would want to leave people with is not that as you get older, your asset allocation should be constant or go down or go up. Any of those things are possible depending on your specific circumstances. Rather, it's that your optimal asset allocation will be a function of your risk aversion, your subsistence consumption, and your bequest priorities. And other things too, but those are three of the biggest influencers on it.
I remember the concepts about the human capital and the financial assets kind of inverse proportional relationship. Like, when you're younger, you have a much human capital. As you're getting older, you're going to have a less human capital because you're getting close to retirement. I'll move on to the leverage ETF question. So leverage ETF, very popular in South Korea. The ETFs that correspond to 2 or 3 times to daily performance of a major indices. For example, S&P 500 and then NASDAQ 100 index. Today, the amount of TQQQ held by Korean investors is at $3.4 billion, which is 15% of its market cap, like $22 billion approximately, I believe. I think that there's a lot of information, misinformed investors about the structure of the triple Qs. Some people wrote books about concentrated holding in a leverage ETF with incorrect information. I would like to get your thoughts on leverage ETF craze. And can you also explain the risk of a leverage ETF using concept of a volatility drag?
Sure. We wrote a little bit about the leveraged ETF in an article a few years ago where we used the idea from the comedy show Seinfeld, a very popular US comedy, where one of the characters, George, who's always making bad decisions, decides that he's going to win no matter what. He buys a 3 times leveraged ETF that goes long the S&P 500, but he wants to be sure that he's going to have something that wins. So he buys also a 3 times leveraged ETF that short the market. So now he's long in one and short in the other. And we show that actually after a couple of years, the stock market went up in the US, but both of his ETFs lost money. And the reason for that is exactly this volatility drag, that thought about in the simplest way. If you have something that goes up 50% one year and goes down 50% the next year, you have $150 after 1 year, but after the second year, you have $75. So you lost $25 over 2 years, even though the average return was 0. You made 50 and lost 50, the average is 0. And so, I think that a lot of people don't realize that with leveraged ETFs, you're not getting 3 times the return of the underlying index, say measured on an annual basis, and then maybe minus 2 times the funding cost. But maybe people don't even think about the funding cost. You certainly aren't getting 3 times the return minus the funding cost, because it's rebalancing its portfolio on a daily basis, and that's creating all of this volatility drag. But even if it weren't rebalancing daily, the volatility drag is still there. It just is transformed into a certain probability that you lose all of your money. You know, if the market goes down, if you have a 3 times leveraged ETF and there's no rebalancing and the market goes down 33% at some point, you've lost all your money and the thing is over. So, you know, I think that people don't quite understand, you know, exactly the full mechanics of these. There's also quite a relatively high cost structure that's inside there because they're using derivatives and they're doing agreements with investment banks that are pretty opaque in terms of how the rebalancing is done. But the most important thing to think about when approaching these leveraged ETFs is really this question of how much equity risk do you want to begin with? You know, that we don't really see why there would be many people out there whose view of stock market returns is so optimistic, whose view of the riskiness of the stock market is so, you know, is also so optimistic in terms of low risk, and who also has such a low coefficient of risk aversion that they would want to have their money in a 3 times leveraged ETF anyway. So, you know, to begin with, we just don't think that there should be this demand for it, you know, away from, you know, people just wanting to take quite a lot of risk with their money. I mean, there is, you know, maybe there's some argument that when you're young and you have just a little bit of money saved and most of your wealth is in human capital, that you should be leveraged in the stock market. You know, I guess that's kind of a reasonable point of view. You know, so a leveraged ETF at that point could make sense. You know, also buying call options could make sense. But overall, you know, we think that, you know, probably it's just better to follow a more conservative approach until your financial capital, you know, gets more in line with your human capital as you get older. You know, I mean, also, there's just this idea that when you're young, you know, in order to have a smooth consumption path over your life, you should borrow money when you're young and spend it and not save anything, you know, have a negative savings rate. And we think, you know, that might make theoretical sense, but in practice, you know, we think it's just better. And with all of the uncertainty out there around jobs and income and the stability of human capital, that for most people, we really think that when you're young, kind of develop those savings habits, you know, even if the academics are saying, no, just, you know, try to smooth out your consumption over your life and borrow money when you're young. It's hard to make the transition, you know, from that. And also there's just a lot of risk. You know, the academic finding kind of looks different when you really put in a lot of risk into your human capital.
Maybe the recent stock market shock that was driven by recession fear must be one of the examples that shows how the leverage ETF is dangerous.
Yeah, we haven't really looked specifically at the performance of some of these leveraged ETFs, but they must have had a hard time, you know, in those few days that were so volatile. And in particular, you know, in markets such as the Japanese stock market, if there are, which there probably are, some leveraged ETFs on the Nikkei index, you know, where Japan was up and down 10% on a couple of different days. You know, that would have had a really big impact on the performance of leveraged ETFs on Japanese stocks, and maybe other markets, you know, also had some really big swings on those days as well. And, you know, one of the things that we talk about in our note on these leveraged ETFs is that, you know, I mean, not that this should affect somebody's decision about whether or not they want to buy them, but maybe a little bit it should, is just that the flows, the hedging flows from these ETFs, when the market moves a lot, the hedging flows can be really dramatic. I mean, these leveraged ETFs, I mean, I think that there's, I don't know, maybe close to 100 billion of them now in the US market and more around the rest of the world. That when the market goes up or down, when the market goes down, they need to sell, and they need to sell in whether it's a long leveraged ETF or a short leveraged ETF. When the market goes down, in both cases, they need to sell to rebalance the portfolio. Both of them need to sell. And the same when the market goes up, both of them need to buy when the market goes up. So this is kind of pretty destabilizing, and the amounts of money involved are large. Like these leveraged ETFs can need to sell tens of billions of dollars of stocks at the closing price or buy them at the closing price if the market went up. And everybody knows that. I mean, you can be sure that all of the smart money out there, all the smart traders, from Citadel to D.E. Shaw to Renaissance Technologies, all these guys, of course, they know exactly about this. And, you can be sure that there's a little bit of slippage that's happening, especially when the market moves a lot. So, I think it's interesting. I think that, we think that ETFs is such a great innovation for investors, low cost, really accessible, indexing that for US investors anyway is tax efficient, maybe for Korean investors too. But then, like all kinds of other people came along and said, oh, let's use this structure to give people all this crazy stuff. And now we have, leveraged ETFs. We have ETFs that are buying options. We have ETFs that are selling options. We have ETFs that buy 7 stocks. We have ETFs that buy 1 stock and leverage it. Like, how can, it's just insane what's going on with what was started off as sort of an index fund improvement.
So recently, the stock market was really volatile. Nasdaq index was up and down more than 1%, 8 consecutive days. I wonder what would be the good strategy to such a volatile market, and how did the Elements portfolio was changed recently?
Plus, you have a upcoming U.S. election too. There's a lot of factors that are affecting the market performance now.
In some ways, I guess if you thought about, what would be the golden rule of investing, the golden rule of investing might be to build your portfolio that has the best ratio of return versus risk, where we measure return as return in excess of safe assets. So, come up with the portfolio that has the best return versus risk, and then decide how much of that portfolio of risky assets you want based upon your risk aversion and based upon how attractive that is. So, if that's our starting point for thinking about investing, then, it's clear that the higher the expected return that the market is offering, the more we want to have risk in our portfolio to get return. But also, since we're focused on this ratio, not just expected return, but the ratio of expected return to risk, the higher the risk is, the less exposure we should have. So it kind of makes sense over time to be tracking those two things and to be adjusting your portfolio dynamically as those two things are changing. So we're going along, and all of a sudden the market just gets a lot more volatile. It makes sense to reduce your exposure in that circumstance. Now, exactly mechanically how you do it doesn't matter that much. You might do it, based upon some tracking of recent volatility or some forward-looking volatility measure, looking at the options market. And of course, we saw this huge jump in the VIX index. If we're long-term investors, we might want to look at some longer-term measures of historical volatility or options market volatility, not just VIX, which is, giving us the next 30-day kind of estimate, but maybe something longer. But, they're still all of those things are going to be kind of correlated with each other. It's not when VIX goes up to 50% volatility of 1 month options, you can be sure that 1-year volatility is also gone higher too, that people are expecting overall a more volatile market. So the way that we've implemented it at Elm is we have a risk metric. Instead of using options or realized volatility, we use a momentum metric, which is doing pretty much the same thing, that when momentum is positive, when today's market is above a 1-year moving average, that tends to be a lower risk kind of environment, and vice versa when momentum is negative. And we like that. It's a little bit more slow moving. So for instance, when we had this huge volatility spike a few weeks ago, momentum didn't really change, so we didn't do much in our portfolio. But if it had continued, if what was going on at the beginning of the month had continued, we would have reduced exposures versus where we started. As I said, as long as you're generally doing the right thing, with regard to risk, it makes sense. We're not saying that our way of doing it is the best way. It's a good way, though. We like it. It's very comfortable. It's like the simplest. In some ways, it's the simplest way to do it because you don't really, need to make decisions about what other, there's so many signals you could use when you get into volatility. Momentum, most people think about momentum as looking at a 1-year kind of look back, whether a moving average or looking at a 1-year past index levels. So yeah, that's how we do it. I think that, with regard to the upcoming US election, the world always has so many things for us to worry about on the horizon. And I would say that it's almost never been the case that I can think of that the things that people were worried about were the things that we should have worried about. That if the market is going to go into a crisis mode, I'm pretty sure that I would have no idea what's going to cause it. Something is going to cause it. The next crisis is coming. I don't know when. I don't know what's going to cause it. I mean, I would almost say it's very unlikely to be the US election. It has to be kind of a surprise. I mean, what's the surprise with the US election? We know that it's 50-50 between these two people. So we know that already. So, okay, what, I don't know. I don't think that that's going to necessarily be it, but who knows? It could be anything.
So it sounds like if you made a right portfolio based on your risk preference, it is okay to move on without change of it, even though there is a volatility. But if there's a change of the momentum, you need to fix it. Is that right?
And usually, momentum and volatility are walking the same path, not exactly every day the same, but overall they're tracking each other, pretty well if you would use one versus the other. And it just turned out, it could have easily been the case that, in the volatile period at the beginning of this month, that that our momentum metric might have switched over and we might have decided to sell. So it really, each case is kind of a little bit different. But as I say, overall, over a long period of time, what we're doing is very similar to other ways that you could do it. It just turns out that for us, we didn't do anything, which I guess we're glad about. We're glad we didn't sell. If we had sold, we would have been buying back too. So I'm glad that we didn't get too moved by that short-term volatility. Now, in early 2020, when the market became very volatile because of COVID and what it was doing, I wish that we had reduced our exposure faster. We reduced our exposure, but not so fast. It was still 2020 was a good year for our investors, but yeah, I wish we had, as soon as the market started to get volatile, I wish we had reduced our exposure completely. But you never know what's going to happen, and you just have to. The important thing is to choose a way to invest that makes sense, and then stick to it. Don't try to second guess it all the time because nothing is perfect, and what's worse, it's probably worse to constantly change what you're doing based on how you're doing recently. That's probably worse. That there's no discipline in that at all. It's probably better to just be disciplined and recognize that whatever you're doing is not perfect, but it's good.
Thank you. So the lessons from the book seems really important, not just for the investors, but also for the entrepreneurs making the investment decisions. So what are the key factors that should be considered when deciding to expand their business, you think?
When deciding to expand their business, obviously, in general, there's a lot of inputs to that decision. One of the important things is the commercial dynamics of that. Is there a market for your product? Things like that. As it relates to the sizing question, one of the important inputs if you're an entrepreneur is how much of your personal capital do you have in the business, and is it too much? One unfortunate dynamic of entrepreneurship is that it's often the case that you just have to keep more of your personal wealth in your business than would be optimal, than you would like to. And, maybe one way of thinking about why certain kinds of entrepreneurship have such spectacular upside returns is that you need that compensation for having to run, an investment policy which is otherwise very suboptimal, sometimes for a long time. But one of the big factors that goes into it is how much of your own capital will be needed. And I guess the other point I would pull out from the book is that it's almost always better to think about risk-adjusted return than to think about expected return. So if you're making growth decisions in a business, you're investing capital in whatever, and you're trying to think about what is the right amount of capital to invest in this, which is going to be connected with, how much should I grow? As many businesses often do, just taking a base case with kind of no risk around it and just saying, what's the outcome in my base case is much less useful, we think, than trying to think about, not what is my base case expected return of the capital I'm investing, but what is the risk-adjusted expected return? And how does that compare to other uses of capital?
On the question of personal entrepreneurship, investing in your own business, James covered everything very well there. Yeah, people get very emotional about their businesses. Even if you're going to be emotional about it, take some time to not be emotional about it and then go back to being emotional about it. At least figure things out on a non-emotional basis. And once you've done that, now you can be emotional again, be your normal self, but at least you have an answer to the question of what you should do. And I think that that people don't take that time to really think clearly about the risk that they're taking. These startup kind of businesses, it's just such a huge investment. It's your human capital, it's your financial capital, your reputational capital. It's such a huge investment, that when it doesn't work out, it's just so painful. And so it's important to do things that really maximize your probabilities of having good outcomes effectively, to maximize, you're maximizing that risk-adjusted outcome. In a very risky situation, it means doing things that are reducing your expected value, the expected amount of your wealth. So it's like selling part of your company to raise more money to make sure you can survive. But those are the things to do, thinking about expected utility or your risk-adjusted outcomes, and not just thinking about your expected outcomes.
Yeah, if I could elaborate on that, to the point of what Victor just said, I've seen it quite commonly where many entrepreneurs are focused on doing everything they can to maximize the best outcome possible. So, they want to maximize their upside in every way. And one of the lessons of optimizing expected utility is that you should be doing the opposite of that. If you're an entrepreneur, you have a risky business, your upside is already really good. And, making choices that make your upside go from incredibly good to incredibly, incredibly good isn't really going to change your expected utility very much. Whereas making choices that make your downside go from unbelievably bad to only moderately bad, that can really move the needle on your total risk-adjusted outcomes.
Just one last question.
Go ahead.
Any advices for the Korean investors? Both of us are in South Korea, and we talked about triple Qs, and also the people over here love Tesla and Bitcoin, like as you mentioned. Whoever considering the investing risky assets, do you guys have any advices?
Yeah, I think our advice for all investors, and maybe particularly for investors in outside of the U.S., think about international diversification. To have 70% or 60% of your equity exposure or 100% in Korean equities, you're not taking advantage of the ability to diversify across all different businesses, all across the world, all different government policies, fiscal policies, everything. So diversify internationally, and don't buy single stocks. Buy low cost ETFs and index funds to get your exposure. I assume that there's lots of low cost and liquid options that are available for South Korean investors. So don't take too much risk. Take some risk, but not too much risk. And don't spend all your life trying to grow your money. Spend your time trying to make money and try to have a fulfilled life. That trying as an individual to beat the market when that the sharks are swimming in the same pool as you are, you have no chance. That there's no chance for anybody to really make money themselves, as an individual. Or in some social media group or whatever, over the long term, you really just have no chance. That maybe you get lucky, maybe you're not lucky, but over time your luck will run out. And so just put your focus on making money, saving money, and investing wisely. I think is the best advice we can give.
In English, sometimes we say the best is the enemy of the good. And, something I see fairly often is that people get discouraged from thinking sensibly about something because they conclude that they can't do it really precisely. And, with investing, it's hard to do anything really precisely, but that doesn't mean you shouldn't do it. And one of the lessons of the book is that expected utility is very flat in the vicinity of optimality. And that means that to get a good outcome expectationally, you don't need to figure out, if your risk aversion coefficient is 2.1 or 2.2. You don't need to figure out whether your optimal equity allocation is 62% or 63%. You get a huge amount of the benefit, the vast amount of the benefit, just by getting in the right ballpark. And I think that having that thought process of I'm just trying to get in the right ballpark takes a lot of the pressure off of feeling like, I have to get this just perfect. And it makes it a lot easier for people to get to a sensible place with their investing.
Well, thanks for all the insights and the time for today. Thank you.